Welcome to Deep Economic Thoughts with economist and best-selling author Ivan Elon. Once in a while, Ivan shares an unscripted, though potent, idea related to economics or the capital markets. This may be of interest to financial advisors and retail investors alike. Enjoy.
Hello, this is Ivan Elon, the founder and chief investment officer at Aligned Wealth Advisors Investment Management, also known as AWAIM. Thank you very much for joining me on this latest podcast episode and the final podcast episode for 2023. Today is Friday, December 29th. I am in the office today. It's a very peaceful time of year to be in the office this week between Christmas and New Year's. Obviously, it's a great time to vacation, but we didn't vacation this year, and that's okay. Some years we don't do that, and that's just the way it is. But it's been a wonderful holiday season nonetheless, and seeing friends and some fine dining in the midst of a really great holiday season. I hope you had a wonderful holiday season as well. And just like that, here we are now faced with 2024. And that is, from a numerological standpoint. Not like I believe in those things, but, it's something to reference. In the Chinese culture, which is very ancient, thousands of year old culture, the number 8 is a very significantly positive, brilliant year. Anything dealing with 8, adding up to 8. So 2024 happens to add up to 8. And so it is supposed to be a year of great growth and things coming to fruition and all these very optimistic things. And at the same time, I think it's a little hard to lean into that idea right now when you think of U.S. presidential elections coming up. 2024 is going to be a highly volatile political season. You already see the beginnings of it with Trump not being allowed on certain ballots in different states. And so there's a lot of big question marks with regard to how the presidential election is going to play out. More importantly, though, and of course, our focus, around here in the work that we do in investing money and managing client portfolios and working with financial advisors and their clients, we have to look beyond just one or two or three different factors. As global macroeconomic forecasters, we have to look at everything. Several years ago, I published an article in Forbes that asked the question, what's next for the stock market? Here's the formula. And so you can Google it and see the formula that essentially is a very helpful framework for how to think about what comes next in the stock market, really for any domestic economy. It's useful for any stock market around the world. This particular formula has a variety of factors that are sometimes paired and sometimes standing alone as their own factor. But essentially, when we reference this framework of looking into the future and really trying to think about where are we going to be positioning client capital and where are we most comfortable, where can we put our money and make sure that we're sleeping at night at the same time, and at the same time, what if we're wrong? And so we can't put all our eggs in one basket. We have to be diversified, but we want to be diversified in an intelligent way, in a forward-looking way. And this year, I think we've done fairly well considering how defensive we have been. So we actually delivered some very good returns in our client portfolios, and the fact sheets and performance will be published early in the new year, and you can reference those. But our concerns are still very similar to worrying about the valuations associated with the Magnificent Seven. This is the so-called Magnificent Seven. We're not in the camp of believing that those are magnificent. We're in the camp of believing those are more mediocre. Earnings per share growth has been fairly mediocre for those 7 companies that have been leading the S&P 500 in 2023. And so, if they've been leading and they've been delivering, some say as much as 90% of the total return of the S&P 500 has come from just these 7 companies. And even though we've seen a little bit more participation from other companies toward the end of this year in terms of contributing to growth in the S&P, by far it's been these 7 companies that have driven all of this S&P 500 return. Now, what I want to focus on a little bit in this particular podcast as we look into 2024 and think about the conditions economically that exist, which is much higher interest rates than what we saw for the majority of the previous decade, much higher Fed funds rate, even if the Fed funds rate declines, even if the Federal Reserve decides and the chair and the board decide to cut rates a few times during 2024. It's likely they could cut it, but they're going to cut it when economic conditions deteriorate, meaning increased unemployment, reduced payrolls, reduced consumption. So we're going to see some kind of economic impact, and the Federal Reserve will then react accordingly to ease the that restrictive monetary policy that's been underway for about a year and a half, over a year and a half, year and 3/4. And so referring to that particular period of time, if we look back to the end of March of 2022, when the Federal Reserve in earnest began the rate hike cycle that has been underway since March of essentially spring of 2022. And you look at different stock markets, you don't really see a particularly exciting story. And so this has been during this period of rising rates, rapidly rising interest rates. And the Federal Reserve rate went from, essentially zero all the way up to nowadays somewhere in the, 5, where is it? As of this morning, sitting at around, I call it 5.5 or so. So, that's pretty high, pretty significant. And that's certainly put a lot of strain on the economy. But during that period of time, the S&P 500 is up about 5%. This is through yesterday's market close. Let's see here. Actually, S&P 500 is up 5.58%. The NASDAQ over that period is up 6.15%. The Dow's actually the best performer during this period of this rate hike cycle, up 8.74%. The MSCI All Country World Index is up 2.42%. The MSCI, excluding the U.S., is up, down negative 2.05%. The Bloomberg U.S. aggregate, that is the U.S. bond aggregate index, is down negative 2.4%. And the Bloomberg global aggregate bond index is down negative 5.37%. So I think it's super important to look at the totality of what has happened to stock markets and bond markets going back to the beginning of this rate hiking cycle that began in spring of 2022. An incredibly informative period of time where monetary policy got extremely restrictive. And the bond markets certainly have not performed well within that context, with that as a backdrop. And equity markets have more or less been struggling over a year and 3/4, basically eking out single-digit returns. And so it's too easy to look at the returns from 2023 and forget that during this rate hike cycle from beginning in the spring of 2022, in early January of 2023, from spring of 2022, the NASDAQ was negative about 26%. It had fallen more than a quarter of its value. The S&P 500 was down 14%. The Dow was off about 3%. The MSCI All Country World Index was off about 13%. And the global aggregate bond index was down about 10%. U.S. index down about 6%. So let's not forget that there's been some incredible volatility during this period of time. Now, what has really changed since early part of January of 2023, earlier part of this year? And I posit that not much has changed. The Federal Reserve has decided to begin to message maybe something a little bit softer, a little bit more dovish in terms of its monetary policy looking forward, but by no means has a true victory been declared, and we haven't seen the economic impact of this rapidly rising interest rate environment. CFOs are still very much scrambling to figure out exactly how are they going to meet these increased debt payments from the refinancing from very low cost debt to much higher cost debt. And you can use certainly some of your cash reserves, but that only goes so far, and that also creates other risks when you're spending down your cash to pay off debt. So it's a very interesting balancing act that many companies are going to have to face. And certainly the consumer has been quite helpful in navigating these times, because revenues have remained fairly decent, although profits have been pinched because of these higher debt costs that these companies have had to absorb. So that isn't going away in 2024. It certainly hasn't gone away in 2023. And let's not forget that monetary policy typically has long and variable lags associated with its impact in the economy. And generally speaking, that can take about a couple of years before you fully see the impact in the economy. And guess what? The spring of 2024 is going to be about a couple of years since that restrictive monetary policy has gone into effect. And so we may very well see a quite volatile 2024 early on in 2024. And certainly at our firm, we're in that mindset. We are prepared for that. We still have a significant underweight to U.S. large cap stocks as a result in our portfolios across all of our strategies. And that's very important for us because we think that those valuations, particularly for those magnificent seven, as they're called, are just absolutely unsustainable, and the valuations that are just unjustifiable. AI, which has been the primary driver and theme that's driven those prices so high, that's just something that's going to impact positively many different industries across the board, many companies across many industries. And so it's very unfair that those companies have just ridden kind of a wave of euphoria. And as a result, those prices are what they are. So that's an area of great concern. And yet at the same time, we're quite optimistic about where we will be able to find some great investment opportunities, particularly within corporate credit, corporate debt. And we're not quite there yet. We see spreads relative to risk-free rates extremely compressed, as if there is absolutely no fear whatsoever. There's no concern whatsoever. And so we see spreads compressed at levels that essentially reflect that there's absolutely no to little risk in the debt markets. And I think that is pretty ridiculous, I think, to put it simply. because, in fact, there's tremendous risk that many of these companies are facing in navigating around the refinancing risks from their colossus of corporate debt that they have taken on during this period of extremely low interest rates. And of course, my hope is that the federal government is not stepping in to bail out all of these public debt markets of corporations. If they did that, basically, you heard it here first. If they do that, our entire capital market system is completely over, and it's the end. And so my hope is that doesn't happen. Unlike how when they stepped in to backstop the FDIC for depositors that had over $250,000, that was the first indication that they're happy to essentially backstop rule breakers, people that didn't follow the rules. That's not good. The whole point of the capital markets and capitalism in general is that there are winners and losers, and that there should be losers because dumb capital allocations need to be punished, and you need to lose money in order to have a proper capitalist system. And so that was I think a big error, one that hopefully isn't duplicated, but we shall see. Being in a political year, all kinds of things can happen. So those are my comments for you. I got about 16 minutes of them in today in this podcast, and I wish you all a very happy and very healthy, most importantly, a very healthy 2024, and also a prosperous one. I think there is a lot of opportunity within the year ahead, and that is usually how it goes. There's danger. In crisis, the ancient Chinese character for crisis is the combination of two characters. The first is danger. The second is opportunity. And so opportunity does exist in the year ahead. You just have to know where to look. Signing off for now, and looking forward to speaking with you again and sharing some insights with you next year. Happy holidays.
For more deep thoughts, please subscribe to this podcast. Also, please feel free to visit www.ivanilorn.com to submit questions or topics through the contact page. Until next time, keep thinking deeply.